This is a timeline of a typical startup. Actually, honestly, scratch that, because this is a timeline of an ideal startup journey, but few startup stories are ideal. 12 years after starting Slidebean, we're probably somewhere around this area, but I sat down the other day to talk to two founders who've been through that side of the process. Starting a company is by all means like a life decision, and you shouldn't get into it unless you're absolutely prepared.
My name is Caya, and I'm the CEO here at Slidebean.
For the pain that will be seeing it through. So I want to break down what I've learned in the 15 years since I started my first company, and with the help of Adrisio and Devrim's stories, help you avoid making the same mistakes that we've made along the way. So let me start by focusing on this section. And to keep things simpler, let's just use a straight arrow, even though, remember, it's anything but. Now, navigating this section of the timeline is probably the most well-documented part of building a startup, and yet we keep seeing the same mistakes again and again. In team forming, the biggest problem I see is that a founder with an idea tries to recruit people to execute on his vision. And that's not how starting a tech company works. You want to have some shared ownership represented not just in stock, but also in the company vision.
I always think that it's better to start brainstorming with your teammates. Typically, one member of the team has the kernel of an idea, they'll become the company. But it's always best, before that gets too solidified, to discuss it with your teammates so that everyone buys in and gets ownership.
That's Michael Seibel, by the way, one of the partners at Y Combinator, co-founder of Justin TV, aka Twitch now, and current board member at Reddit. Creating a team is a test in and in itself. Like, you need to have a network, you need to be easy to work with, and you need people to see the value that you provide. It's a big red flag that your first MVP was built by an agency, or even worse, to raise money to do that. It means that you couldn't find anybody else who believed in this product or in this company.
2 to 4 co-founders, at least 50% engineering. They all have to have somewhat around a year's worth of money in the bank, but that doesn't mean a year's worth of money living in a one-bedroom apartment, like in a high-rise. That means a year's worth of money eating ramen noodles and being very poor. And everyone has to have quit their jobs.
Funding requires a show of commitment and a leap of faith. When you're younger, living in your parents' basement or eating ramen noodles is a real option, but that's not an option as you get older. Now, I'd say it's perfectly fair to do some freelancing during this time, as long as it's clear that your main gig is your startup. Like, don't sell yourself short on how much you charge. In the end, you're looking to be paid very well for a few hours, so you can use the rest of your time to build your company. Make sure that you count the percentage of billable time and your time off as you calculate your ideal rates. I always use this calculator to make sure that I'm not selling myself short. I'll link it below. Still, having some funding, at least to get the company going, is also a bit of a test that you need to pass. It's easy to find seemingly crazy rounds of funding, and many of those rounds are indeed crazy, but check out who those founders are. They have a track record, they have connections, maybe even previous companies under their belt. Raising money at pre-seed is really, really hard. Harder than any other round, to be honest, but you have to convince people purely on your character and your experience, but you don't have any metrics to talk about. Now, another point with funding, please remember that money is just a means to an end. And it's very easy to run out. It's easy to think funding is the goal because we have to spend so much of our time in the early stages thinking about raising money, but it's not. Now, with pre-seed funding, be very careful with convertible notes. We made a whole other video about that. Now, another tip, don't get caught up on advisors. Most advisors feel very valuable when you're alone and you need second opinions, but that should come from your co-founders and from your team. Don't be so quick about giving advisors equity. Actually, don't give them equity. Go with stock options and make them earn them. Now, the first couple of years of a company are grinding, and advisors don't tend to be very useful for grinding.
Where most companies will screw up is on team. This is the second place most companies will screw up. How can you get something into people's hands? I can't tell you, I've done this many times myself. The number one piece of advice we give to YC companies before they launch is launch. I can't tell you how many people will just sit there and iterate before users ever see anything. So when I ask a company how long it's going to take to launch, I always just ask them, why does it take longer than 2 months? Like, I don't care what it is. I don't care if they haven't started yet. You should be able to build something in 2 months and get it in front of users. This is just saying it one more time, you're nothing until you launch.
Now, there are some caveats to this. Not all companies can launch without funding, but many do. I can normally group companies into regular tech startups, and R&D companies. Regular tech startups are your typical SaaS tool, your software, your platform as a service, and those can normally be built by piggybacking of existing APIs and infrastructure. This is in the 90s, you don't need to buy servers anymore. R&D startups are the exception, and those might be hardware products or deep R&D technologies that need years of development before seeing the light of day, like building a new LLM. Like, I would assume that if you're building that, your team is an expert in the field and you're not looking to hire them with your round of funding. By the way, if your business doesn't qualify as either of those two, what I would call a non-tech company, this is maybe not the video for you. Like agencies, dev shops, Shopify stores, you guys are startups, you guys are using tech, but for the purposes of this discussion, you are not a tech startup. These two categories, R&D and tech startups, can get away with, honestly, with massive rounds of funding, but the expectation from investors is that you will see these companies through to an exit. There's no posing as a tech startup to then decide that you want to grow slow or that you don't want to sell your company. If you choose this path, the only way to make your investors happy is with aggressive and yes, very risky growth. Now, I said before, there are a lot of resources to navigate this part of the process. A fair share of those were made by us, which now you've discovered, but this kit by HubSpot is a pretty incredible complement. It has a suite of tools inside, including that hourly rate calculator I showed you earlier, but my favorite was the ebook Ultimate Guide to Becoming an Entrepreneur section, which has tons of insights and identifying and debunking ideas, different approaches, and building your first MVP. You can also download that for free. Link in the description or this QR code. After companies reach pre-seed, whether you have money or not, the biggest mistake that companies make is failing to budget enough money to get to the next round, to get to seed. Like getting stuck between rounds is really bad, and I know because it happened to us. In SaaS, a seed round happens ideally at about $10,000 to $30,000 in MRR, and a Series A round is at around $2 million in ARR. Now, if you run out of money halfway, you'll be in a very bad position to access any funding because nobody wants to put money in a sinking ship. When you're pre-seed, you can raise money on the dream and on the vision, but once you have a product in the market, the expectation from investors is traction. I can't count how many founders fail because they spend their savings in building a product without ensuring that they have enough oxygen to launch it or to iterate on it or to be able to get their first customers. Now, we got stuck between seed and Series A because we were told that we needed 18 months of runway, and we did. I stretched our round to 18 months. But when we were about to run out of money, we had gotten to about $1 million in annual run rate. So we were too early to get through the door to the Series A investors. Okay, so back to the team. Let me talk about teams between pre-seed and seed. Like, even if you're funded, this team is taking a massive risk by working with you. You have to acknowledge that. These guys may have a more decent salary than the founders, but they need to believe in the company almost as much as you do. Like, they should be entrepreneurs too. Maybe they didn't dare to start a company on their own yet, but they need to be at a point in their lives when they're ready for the crazy work and honestly to do a bit of everything. I think that must be compensated with stock options. This early team will shape your company in more ways than you can ever imagine. So my suggestion is be transparent with them about where the company is. I always believe that over-communicating is better. If you need to cut them because you're running out of money, don't let that be a surprise to the team. Not everyone can live and work with that uncertainty, and that's fine. Some people are meant to be employee number 42, not employee number 3. Now, at this stage, you should have a perfect grip on your budget. You should know how much runway you have, always, and you should always make decisions based on this. We have a team division dedicated to building and keeping our customers' financial models updated against their books if you're interested in some help. The financial model is a tool that you should be using on a weekly basis because every decision should be budgeted, every hire should be made only after you understand how it affects your runway. More info about that stuff here, if you're interested. Related to that, remember that funding rounds take months to close, especially at the early stage. During the first 3 months of that process, the founder doing the fundraise will be out. Like, you will not have time to do anything else. Your company needs to be ready to exist and keep growing with one of the co-founders essentially missing. And it's not easy. Another common mistake I see is what I call unexplainable growth. So I talked to this company the other day. They were doing about $500,000 in ARR, but a lot of their growth came from campaigns that a third-party agency ran. So let's break this apart. External agencies for specific projects are okay. Maybe a UX rehaul, maybe PR, maybe even sprinting a feature, but the core competencies need to be in-house. You can't have a marketing agency without an in-house growth hacker. And this became a deadly problem for this company because as they approached their Series A, investors asked, well, what are your most successful campaigns? And what are their unit economics? And they just couldn't answer the question. Series A rounds are raised on metrics. And most of the capital will go to growth. You need to be able to prove that you understand where that capital will be deployed to accelerate that growth. The Series A and Series B pitch decks that I've advised on, they're all super metrics heavy. It's all about showing that you know where to put your money to keep growing fast. Now, another common oversight on Series A rounds is how expensive they are. You should prepare yourself for a $50,000 to $100,000 bill on legal fees, and that only gets worse as rounds get bigger. Okay, so now we've reached a point where our company hasn't gotten to yet. So as I mentioned, I spoke to Devrim and Adricio, two founders that recently sold their companies to Skillshare and to MasterCard respectively, so they can share some of the stuff on the mistakes that come as you get to the end side of that timeline. Now, Devrim raised a $2 million pre-seed round and an $8 million seed round.
I've never seen anything like that. I mean, I raised money before. I've never seen those valuations. I've never seen people just piling up to give you money and trying to squeeze each other out of the deal. Like one investor comes and says, I'll do the, triple the valuation, more money and things like that.
Which sounds good. Lots of money, little dilution, but remember, funding is a means to an end. What happens after you raise $8 million at a $40 million valuation, let's say? Like the next round has to be over $100 million. And it's hard to justify that if you don't have the traction. Lucky for Devrim, Skillshare was already looking at them.
Well, when we started SuperPeer in 2020, the entire company signed up. That was all the way back then that we knew that they were looking at us. In 2023, by checking how much more work do we need to do to actually get to a point where we can justify our valuations.
Now, in case of Adricio, it was his Series B conversations that triggered this whole acquisition move.
In 2020, we were raising our Series B. I was out in the Valley and raising our Series B, and then the pandemic happened. So my wife and I skipped San Francisco and went to the Dominican Republic and started doing a Series B from my wife's mother's house. MasterCard, we also have some kind of relationship with them as well, but nothing formal. When they approached us initially, it was as an investment, that's part of our B, but that conversation quickly grew to acquisition. And we actually said no, maybe 4 times.
From a founder that has not sold any startups ever, feels like selling it is kind of like the end game. Why would you say no to these 4 first offers?
I think the first factor is where you are and where you think you can be, right? So, startups hit some pivotal points in their trajectory, and I think we thought that we were about to hit one. So we thought we had like a massive opportunity in our hands. I was going through a lot of turmoil internally at the company. We had parted ways with one of my co-founders, and I was temporarily fired, right? So there was just a lot of friction internally, right? And I always tell founders, your co-founder relationship is your home. Like when that's broken, it's really hard to do anything else well, because that's where you go for solace and some degree of calm.
This is maybe a good moment to talk about the different type of startup exits. Every deal is different, but we can probably group them into these buckets. You'll read about all kinds of exits in the news, but they'll never say what kind of acquisition it was. But here's a guide I made for you to catch some of the clues. Acqui-hires will never ever reveal the price that was paid for the buy. So that's the first clue. The other clue is that the product is usually shut down immediately or only months after the buy. Normally, the acqui-hired company was struggling, running out of money, maybe they didn't get enough traction to raise the next round, or their product wasn't growing much. You can usually tell because their team was shrinking. Now, acqui-hired companies are usually running out of money, which means they're not profitable, and this usually happens for small startups, say under 30 employees, and the reason why they're called acqui-hires is because what the buyer is really doing is just recruiting a fully formed, trained, and proven tested team. Now, I know a couple companies that were acquired by Google, and each team member had to go through Google's usual interview process for new employees. Some got in, some didn't. Needless to say, nobody makes a lot of money in an acquisition.
Typically, the sellers don't make too much money in these acqui-hire situations. And the reason is that they are not great exits. They are essentially a graceful way for the startup team to transition back into the corporate world, secure a high-paying job without the stain of a failed startup.
Now, this is Attila Hardy. He helps startups with their M&A. He might help us sell Slidebean one day, and he certainly knows more about this than I do.
In these acqui-hire situations, the valuation is essentially the perceived value of the team. How much is this team worth to acquire for the buyer? And this can range anywhere from $100K per capita or per team member to $2 million, depending on a lot of factors. So it's very hard to pin down the exact valuation because the beauty is in the eye of the beholder.
The other extreme of this spectrum is the rockstar acquisitions. That's your Instagram, your Slack, your 22 billion WhatsApp sale. We made a video about it. These are all rockstar deals where both companies are worth hundreds of millions of dollars, and the merger of these companies just makes a lot of sense. Now, they can spare no expense hiring every expert in the world for this whole acquisition process, and the people involved in these acquisitions most certainly don't watch this channel to find advice, so I'm not gonna spend too much time there. We cover those in our main channel, so you should check that out. But here in the middle is where things get tricky.
So the first bucket is financial buyers. These are typically companies who buy businesses for their future cash flows because they want to create a return to their own investors. They typically don't have a strategic or synergic angle that strategic buyers have.
Now, these financial buyers are looking to monetize the company for profits. They're maybe consolidating the tech support or the marketing with other companies in their portfolio so that they can maximize those profit margins. So there's no strategic value for them in the company. It's just really about the profits and how much of that they can collect as profits and dividends.
These buyers value companies based on their future cash flows, and they typically apply a profitability multiple, EBITDA being the most common one, and the multiple can be anywhere from 3 times EBITDA to 10 times EBITDA, depending on a bunch of different factors.
Now, comparing the dollar, like the exit value for one of these acquisitions versus a rockstar exit sucks. That's not what we signed up for. But think about it. Investors essentially are paying you for those profits in advance. If the company isn't growing, how else are they gonna make money from it? So they have little regard for the team or the technology or the brand. It is very much a monetary transaction.
Now, the other type of acquisitions are strategic acquisitions, which are similar to the rockstar acquisitions, just smaller in scale. When a strategic deal happens, it happens because the buyer sees some extra value in what you've built that is not apparent to a financial buyer. Maybe that's the niche that you're in that they want to enter into. Maybe that's the customers you have that they want to start cross-selling their own products to. Maybe it's the technology that you've built that will shorten their own path of getting to a desired outcome.
Now, strategic acquisitions feel closer to what I was sold on when I became a founder. I very much started Slidebean with the intention of selling the company, but a buyer for us would need to be someone who values not just our tech, but the product and also the brand we've created. Now, both SuperPeer and Arcus were strategic acquisitions, but not rockstar enough to polish their acquisition price, so they land somewhere in the middle of this chart.
If we do this, it's life-changing for a lot of us, not just the founders. You have a culmination of 7 years of pain with a few months of really intense pain.
Now, one thing I had no idea about was how long exits would take and how painful they would be and how much work they would require.
How long did it take?
12 months and some. It feels like your life is on pause. At the same time, both parties can exit the deal. That freaking sucks. That's also, some, like, on the back of your head, you're thinking they can walk out of this. Like, if something happens on their next board meeting, someone says something, or another economic downturn, like anything can happen, and then the buyer leaves the table. You had already said no to other buyers, and your team is already like a little bit like on the edge, and you have to manage all this stuff also for yourself.
We wound up kind of like breaking the team down, and we would do like our day job through the day, and at night, like late at night, like 8, 9 p.m. at night, we would meet every night and go over the list, and this is what you have, and we did a stand-up daily.
Then there are investors. You're trying to, make the deal that works for everyone. The worst part is to collect documents if you're missing something from an ex-employee. They usually are not. You are not on the top of their minds. I mean, we always had good relationships with our ex-employees because literally, like, you just get stupid questions in a way you cannot say these are stupid questions. They are stupid questions, but you have to answer them. M&A is designed for both lawyers to make sure that everything is happening exactly legally.
The M&A process is often designed to put companies in a position where the buyer has so much power over the company, so much money has been spent already, so much time has been put in, that there's honestly no way out but completing the sale. One of the founders I spoke to, who couldn't go on record, told me that in the last few stages of the deal, the buyer told them that they had to drop their offer significantly because of some market condition bullshit. And at the time, the company was in a position where they just couldn't back out. They couldn't say no. How was team morale through this?
Your team starts to feel like, should I look for another job? Should I commit 100% here, or should I be like, one leg out? It was dreadful. Not Skillshare's fault, of course.
Devrim had a lot of thoughts on how to manage the team uncertainty through that process, so go check out our full video on exits if you're interested in learning more. And don't forget to grab HubSpot's free entrepreneurship kit here. Catch you in the next one.